I'm here in Dallas for REITWorld 2011, NAREIT's annual convention for all things REIT. I'm joined today by Steve Hentschel, Managing Director and Head of Real Estate Investment Banking with Gleacher. Steve, as we head into 2012, what are some of the trends in the REIT industry that you're keeping your eye on?
Yeah, look, I think we're going to see a lot of the same things that happened in 2011 are going to continue into 2012. So there's global economic uncertainty, sovereign debt issues, questionable solvency of large financial institutions, investors being nervous, market volatility. And then look, we've got the uncertainty of the elections in 2012. So I think the macro overlay is very important as to what we're going to see with REITs. Specifically, some of the trends that I think will continue are going to be the trend of REITs owning core real estate, as people are looking for safety, looking for the highest quality assets. The continued emphasis on major markets, 24/7 cities that have global appeal, trading liquidity, so that's paramount in the market. People are looking for liquid stocks. And then I think we're going to see the continuance of difficulty finding high quality assets to buy. It's just hard to grow. So the things that I think are going to be different though is that first of all, I think right now there's too much of a penalty for REITs with high leverage. Right? So I think the pendulum has swung a little too far in the other direction. So I think that gap will close. There's going to be more of a focus on debt maturity schedules and a little bit less on the absolute level of leverage. The other thing that's developing is we are watching more private capital become frustrated with the low cap rates in high quality assets. Right? So the spread has just tightened too much. So I think you're going to see more B quality assets, secondary markets trade from the public into the private.
So after several years of seeing development take a back seat, we're starting to see some companies get back in the game in terms of getting shovels into the ground. Do you anticipate seeing any sort of construction boom, and are there any sectors which may lead the recovery in that area?
Yeah, I don't think we're going to see a lot of it. Part of the issue is the fundamentals, and a lot of the sectors don't really support it. And then the other thing is construction lenders are very conservative, so the amount of equity that you need to put into a project is significantly greater than it had been. So it's tougher. Where we're seeing development is certainly in the apartment space, and that's the space where I think the fundamentals are the most positive, and when we've had a period where there hasn't been a lot of development. So we're starting to see not what I'll call not new projects, but projects that had started, were put on hold or mothballed, and now being restarted. So I think we're going to see some of that. There is still a lead time because this is happening really in the major markets where it still takes a long time to bring those assets through the cycle. And then we're seeing a little bit of that in office in New York City, Washington, D.C., major markets. So I think there's a little bit of that, but I don't think we're seeing a lot of shovels.
There seems to be a sense of confidence in the recovery underway in the commercial real estate space. But are there any sectors in specific that you see facing more of an uphill battle?
There are. So it's really a tale of two markets. If you look at the recovery in prices that has happened in top tier markets with the highest quality assets, it's been pretty significant. So we've seen a lot of that already. Secondary markets, the prices haven't recovered. So when we think about it, it's in the context of which of those markets are you talking about? And again, some of it's already happened. Like I said, apartments, the fundamentals are fantastic, probably the best we've seen in a generation. So, that is at the one end of the spectrum. The places where there are more headwinds are certainly with industrial assets, whose fortunes are most closely tied with the global economy. And then if you look in secondary markets, I think there's challenges for office, lower quality retail, and lodging. And that I think is going to take longer to recover. I think even, very little recovery, at least until we get through the election next year.
Steve, thank you so much for joining us.
Thanks for having me. Thank you.
For more from REITWorld 2011, be sure to visit REIT.com.